Hey everyone, welcome back to Corporate Decoder, the place where we decode the real story behind those fancy corporate filings. Maybe there is a secret warrant distribution happening, and somebody forgot to mention it properly. Opendoor Technologies Inc. dropped a report, and we are here to break down what it actually means for you and me. So what is the big deal with this particular filing? This is a Form 8, an important document that companies have to file when something significant happens, things that are generally not part of their everyday business, like a major new agreement or a bankruptcy filing. Today, Opendoor is talking about a big distribution of something called warrants. Let's dive into what this warrant dividend distribution is all about. On November 6th, the company announced that their board of directors decided to give out warrants to the people who own their common stock. The warrants were handed out on November 21st to everyone who owns stock as of November 18th. Think of it like a special bonus or a shareholder perk. The company is making it clear this is all above board and being filed according to the rules set by the Securities Exchange Act of 1934. This filing is from Opendoor Technologies Incorporated, and they are incorporated in Delaware. They are a well-known name in the real estate tech space, trying to make buying and selling homes easier online. Everything we are discussing today is happening exactly as the company's own founding rules in its charter state. Their main offices are located in Tempe, Arizona. The company's main type of stock is common stock. Each share has a par value of just a tiny fraction of a cent as specified here. The company's common stock is traded on the NASDAQ stock market under the ticker symbol OPEN. The main event here falls under item 1.01, which is about entering into a material definitive agreement. This means they have signed a significant contract or arrangement. The core of this report is the warrant agreement. This is a legal document that lays out all the nitty-gritty details of these warrants. They are giving out 3 types of warrants: Series K, Series A, and Series Z1. Of each will be given for every 30 shares of common stock held by shareholders as of the record date. Now let's talk about the price of these warrants. Each Series K warrant can be bought for $9 each series, a warrant for $13, and Series Z warrants for $17. This price is called the exercise price. When you exercise a warrant, you are essentially buying the company's stock at this predetermined price. These warrants have a lifespan. Their expiration date is set for November 20th, 2026. However, there is a catch: they can expire much sooner if the stock price hits certain targets. This is an important detail. If for 20 days out of any 30 consecutive trading days, the average stock price goes above a specific trigger price, which is initially 120% of the exercise price for each warrant series, then those warrants can be automatically pulled ahead of their expiration date. This encourages people to use the warrants if the stock price performs well. It is not just common stockholders getting these. The debt holders of Opendoor's convertible notes also received warrants. This means people who loaned money to the company are also getting a piece of this action. When people decide to use these warrants, it means the company will be issuing new shares of common stock. This could potentially increase the total number of shares out there, which can have an effect on how earnings per share are calculated. Dilution is a key factor to watch here. The good news for investors is that these warrants will start trading on NASDAQ very soon on November 24th under their own specific ticker symbols: OpenWoo for Series K, OpenPool for Series A, and OpenZens for Series Z. This means you can buy and sell these warrants just like regular stock. Now we move to item 7.01, which covers Regulation FD disclosure. This is all about ensuring that when a company releases important information, it is not just given to a select few people, but to everyone at the same time. On November 21st, Opendoor also put out a press release about this warrant distribution. This is the public announcement that accompanies the formal filing. This is a crucial legal disclaimer. This report itself is not an offer to sell or buy any securities. It is an informational document. They are careful to state that they are not trying to solicit offers to buy or sell anything through this filing. This is a bit technical but important. The issuance of these warrants itself was not registered under the Securities Act. This is because giving away something for free, like these warrants, is not considered a sale of a security under the law. Like most corporate filings, this report is full of forward-looking statements. These are basically guesses or predictions about what might happen in the future. They use words like anticipate, believe, expect, and well, these are important to read. But remember, they are not guarantees of future performance. The company is explicitly telling you that any statement about the future is a forward-looking statement. They also direct you to their risk factors section in other filings. These are the potential problems that could stop them from hitting their future goals. Finally, we have item 9.01, which is about financial statements and exhibits. This is where they list all the supporting documents for the report. Exhibit 4.1 is the actual warrant agreement we just discussed, which contains the full terms and conditions. Exhibit 5.1 is a legal opinion from Latham and Watkins. LLP, this is their professional opinion that the shares issued upon exercise of the warrants are valid. And Exhibit 99.1 is the press release they issued announcing this whole warrant distribution event. And to wrap it all up, we have the signatures, most importantly, the signature of Kaz Najatian, the Chief Executive Officer, who is certifying that everything in this report is accurate to the best of his knowledge. So what is my take on all of this Opendoor is essentially giving its shareholders and note holders a potential upside. If the company's stock performs well, the warrants offer a way for them to buy shares at a set price, and if the stock price shoots up, these warrants become much more valuable. The early expiration clause is designed to reward quick stock price appreciation, and it also means that investors need to pay attention to the stock performance to make sure they don't miss out on exercising their warrants. The biggest risk here is whether the stock price will actually reach the trigger points for early expiration or even their exercise prices. If the stock price stagnates or falls, these warrants might end up being worthless. It is a bit like a lottery ticket with a defined expiry and a conditional payout. However, this move also signals a couple of things. First, it is a way to incentivize current shareholders and potentially signal confidence in future stock performance. Second, it is a way to raise capital if those warrants are exercised, meaning more cash for the company to invest in its operations or growth strategies. Overall, Opendoor is using financial instruments to potentially boost shareholder value and create future capital, in my opinion. This is a smart, if somewhat complex move for a company in the dynamic real estate market. It is a calculated bet on their own future success. What are your thoughts on this warrant distribution? Do you think it is a good move for Opendoor shareholders? Let me know in the comments below if you found this breakdown useful. Please hit that like button and subscribe for more deep dives into corporate filings. We also have a Discord community linked in the description where you can connect with other savvy investors and discuss these kinds of insights. Thanks for watching. I'll see you in the next episode.